Hello, welcome to Grand Wealth's quarterly investment review. My name is Calvin Wiersma, I'm a financial advisor here at Grand Wealth, and I'm joined by Jeff Williams, our senior financial advisor and managing principal. Jeff, thanks for being with me today.
Glad to be here.
The second quarter was sort of a wild ride.
It was.
But despite April starting off with quite the surprise announcement and a lot of reaction in the markets, the quarter ended really well, and I think there were some specific principles that really helped investors kind of stay the course and come out with a good outcome.
Yeah, it really did highlight a lot of the things that we stress: disciplined investing, diversification, and sticking with a plan.
Yeah.
And through that, we ended with a very positive quarter.
Yeah, and so stock performance, I think U.S. was up about 11%, international developed markets up almost 13%, and emerging markets pretty similar. So kind of highlights again just the benefits of diversification. We don't know where the return will come from, and over the last year or so that has really benefited investors being diversified outside the U.S.
Yeah. I'd say one of the lessons here was, again, the benefit of diversification, and especially international diversification. We've always been strong proponents of investing globally and having a healthy allocation to international stocks and international bonds, but international stocks in particular really helped smooth out the ride. So if you were invested entirely in U.S. stocks, in early April, you would have seen your total portfolio value drop by almost 20% at a point in time around April 8th.
Yep.
If you had a globally diverse portfolio, still would have gone down, but not nearly that much.
Yep.
So it was a much smoother ride, and we still have on a year-to-date basis international developed stocks outpacing U.S. stocks almost 3 times the return on a year-to-date basis for international stocks over U.S. stocks. So it's really been helpful to have that international stock allocation, and we're at the point now where after a couple of years of U.S. stocks outperforming international stocks, we're at the point now where on a one-year basis, international stocks have outpaced U.S. stocks.
Yeah, and that doesn't happen every year, but that's why we diversify, right? Because we don't know when it will happen.
Correct.
But we don't want to miss out on return, and it can help reduce volatility. You mentioned bonds too, and that's again where diversification has been beneficial. Bonds in the U.S. last quarter returned 1.2%, and globally 4.5%. So again, a benefit to being diversified, and that's something that we make sure our clients are diversified in bonds as well.
Yeah. Almost a distant memory now of beginning of April. Now
Right.
we're 3 months away from that, but it was pretty dramatic. April 2nd, the tariff announcement was made, and the stock market dropped very quickly, very significantly. And when that happens, we do take action. We obviously don't abandon a strategy and seek safety. But why don't you describe kind of how we react to market events like that?
Yeah. So we really don't react. We're trying to be proactive on this when things like this happen, right? And so it's not a knee-jerk reaction. It's really just what is our process, and when does it kick into action? And so we have a rebalancing process that really ensures that clients' portfolios take advantage of this volatility and can stick to their target allocations for the long term. So there's been research that shows that using thresholds rather than just some designated time on the calendar to rebalance is the better way to do it. And a couple of reasons for that. One is reduces transaction costs because you're not doing rebalancing every month or every quarter, sometimes when that wouldn't be necessary. And two, the rebalancing you end up doing is just more impactful. And so in April, this was a perfect example. April 7th, April 8th, we saw some portfolios where maybe the overall fixed income allocation was 3% below or above what it should be. And the stock allocation was 3% or so below what it should be. And so we simply sell some fixed income and we buy equities. And it doesn't work out every time where you see that recovery right away, but this time we saw it literally the next day, April 9th, with one of the largest one-day returns in the U.S. market in history, with about 9.5% return because of the announcement of the tariff pause. And that really benefited those clients that we were able to rebalance for, so much so that in about mid-May, we actually rebalanced back the other way and sold some stocks, took some of that profit off the table and bought fixed income again.
Of course, that's totally against emotion and human nature, right? To think of U.S. stocks going down as precipitously as they were, that the thing to do is not to sell and get out or seek safety. It's really to buy more at a low price, at a relatively low price.
Yeah.
And we never know, is this the bottom of the market? We're not doing this on a predictive basis or forecasting or looking at some crystal ball. We're just following a process, but a disciplined process, and one we know that works over time.
To your point, we don't know what will happen, but I can remember we did this back in March of 2020 as well. And we did a lot of rebalancing for our clients right about within a week of the market bottom. But we also, and that was another quick turnaround time, but we also did this in 2022 when stocks and bonds came down. But that was a much longer, more drawn out period. And we maybe didn't end up rebalancing or seeing the benefits of that until later in 2023 or even 2024, when stocks were really recovered from that sell-off in 2022. So it could be within a month. It could take 12 months to kind of see that benefit. But
always nice when the rebounds happen quickly. Yeah, as we know, being in this business, sometimes it does take years, and that's why you really do have to have a long-term perspective and not get caught up in the current day today, even as it is very prominent in the news when the stock market drops. Not so much when it goes up, but we all hear about it when we have a big down day of the market. Any thoughts in terms of looking forward?
Yeah.
What do we expect? We're obviously still dealing with trade negotiations and tariff announcements. What do we expect going forward?
Yeah, great question. The U.S. economy, I think, is just in a position where it's more susceptible to disruption. It's not necessarily on a weak, crumbling footing, but depending on where tariffs go, that could impact things. But there were strong corporate earnings so far this year, which has buoyed the stock market. Job hiring still seems to be solid, and so there are things that are kind of working for the U.S. economy and things that are working against it. And so I think it's just a good reminder to stay focused on what is your plan and really what drives return. So not listening to the headlines, not trying to predict return because of a policy change, but really what drives return for stocks. And that really comes down to the fundamentals. And that's, what is the profit of the company? What are the growth expectations of that profit? And then what is the current valuation? If you have to pay a premium to buy a stock, you probably aren't going to get the same returns if you bought it at a discount. And the analogy that comes to mind is just, if you're thinking about buying a rental property, you buy the cheapest house on the best block, right? You want a really solid company that maybe is discounted for some reason. And you might even generate similar profits as the most expensive house on that block. But because your price that you paid is a little lower, when you maybe go to sell, the appreciation might be more. And so that's really what we try and do in our portfolios, is build portfolios that tilt towards those stocks that have good profits and are at fair prices, both in U.S. stocks and internationally as well.
Right.
And as we look at valuation, so kind of evaluating where return might come from next, not to make a predictive tactical shift, but just realizing what might do best over the next period of time. Valuations at price to earnings ratio in international stocks is much closer to the 20-year average, whereas in the US, we're almost near a 20-year high in terms of where valuations are. So I think going forward, we may continue to see outperformance in global stocks versus the US. Mm-hmm. Anything else, Jeff, that you're thinking about as we approach the next quarter and the rest of the year?
No, just it's important to stay the course. Obviously, when we think about trade negotiations and tariffs, I think what we don't have that crystal ball to predict what stock returns will be next quarter or even the course of the next year. But we do expect we could expect volatility, as we always do with the stock market. But we also know the long-term fundamentals are good, and that a diversified portfolio will deliver solid returns over the long term.
Great. Well, thanks for joining me, Jeff.
My pleasure.
As always, we're going to stay disciplined, focus on what we can control, and see what the future holds. Thanks everyone else for joining us as well. We'll be releasing our quarterly investment newsletter shortly, and you can read a little bit more about what has happened and what is to come in the newsletter. Thanks so much.